Hello, good morning. It's Stuart Marshall from Liquid Expat Mortgages. We are, myself and a colleague, Rebecca, are providing an update to IP Global on the current state of the UK mortgage market for British expatriates and foreign nationals that do not live or work in the UK. My colleague will run through and recap on our position of providing the UK expat mortgage service to our clients, and obviously very topical at the moment. We'll be covering off recent changes and our predictions following the COVID-19 pandemic. So I'll hand over to my colleague Rebecca, who will give an overview of the current marketplace.
Hi, good morning. So my name is Rebecca Pickard and I head up Liquid Expat's office over here in Hong Kong. As Stuart went through there, what I'll be doing is going through a brief presentation just to give a bit of an overview about what Liquid Expat do, how we're able to assist, and also go through some specifics in terms of what mortgages are available. So to start, Liquid Expat, we are specialist mortgage advisors. So we do have 12 years of experience assisting UK expats and foreign nationals with UK and overseas requirements. We are specialists in UK, German and Spanish mortgages for international clients. In the past 12 years, we've had over £3 billion in loans approved and issued, and we have been able to help clients in over 40 countries. The benefit of using Liquid Expat is that we are an FCA regulated company, which gives clients complete security when using us. We are qualified and knowledgeable professionals, and as we are FCA regulated, we do have a lot of accountability to the industry regulator. Another benefit of using someone like Liquid Expat Mortgages is that you are looked after in terms of every step of the process of acquiring a mortgage. So who we can help? So over the past 12 years, we've been able to help both UK expats and foreign nationals, and we're able to help employed and self-employed applicants. Whether that be that you're looking to buy an investment property or whether you're looking to relocate and buy a main residence back in the UK. We're also able to help with both new build properties or existing properties. And the other good thing is that whether you're a first-time buyer or an experienced investor, we do have options for all. So whether that's a property that you already own in the UK and you're looking to release some funds out, maybe to increase your property portfolio, or you're purchasing a new build, or you're just a first-time buyer looking to get your foot on the ladder. So what I want to do now is just give you the current market overview of what mortgage options will be available. The first thing is really key for most investors would be the maximum loan to value. So typically for an investor, the maximum loan to value is 75% of the property value, which means you only need to find 25% cash. We are able to look at mortgage terms anywhere from 5 to 40 years, with the maximum age of being 99 years old. That is of course subject to status and lender, and we will be able to go through in more detail with each individual client. Lenders at the moment are offering both interest only or full repayment mortgages, whichever suits you. And currently the minimum property value is £95,000. Because of the range of lenders that we have access to, we do have access to all product types to suit each individual client needs. So that can be a fixed rate, tracker rate, or a variable rate. And the interest rates currently, which is what most people are interested in, they go anywhere from 2.35% up to 3.99%. Now I appreciate that's quite a big variance. That is subject to status. So that does depend on what passport you hold, your income levels, and the type of property as well. So we'll be able to give you more specified interest rates when we speak to you individually. In terms of affordability, the main way that lenders will look at that is they will base it on the rental income. So typically they'll look at multiples from anywhere between 160 to 200 times the monthly rent. So if we take, for example, a property that would rent for £1,000, potentially the lenders will be able to offer somewhere in the region of 160 to £200,000 for that property. In terms of potentially a property that you're looking to buy that's quite a lower yield property, it's high net worth, we can look at your personal affordability. So if you've got a lot of surplus income each month, we could look at getting you a higher amount of mortgage based on your income. Another aspect that we're able to offer is in your individual name, or some investors do prefer to purchase through a limited company. We do have lenders that are able to offer that to both UK nationals and also foreign nationals. Now what I want to go through is a little bit to do with the eligibility and the requirements. So, as we said previously, we can help both British expats and foreign nationals, and it doesn't matter if you're employed or self-employed. The lenders we work with will require a basic income from each applicant, and that typically is the equivalent of £25,000 or above. When we are needing documents from each client, we will need address proof and proof of name, which typically can be a passport. If required to work in the country where you currently live, we will need to see a proof of visa. And of course, the lender will ask to see your source of deposit. Now, for self-employed applicants, we will need to see 2 years of tax returns or accounts from your accountant. If you're employed, it tends to range somewhere between 1 to 3 months worth of payslips. If you do already have mortgages back in the UK, the lender will ask for good credit history and conduct for current mortgages. Now, another key thing to factor in here is timelines. So if you are looking to purchase an off-plan property, we would ask that you apply at the very earliest 6 months before completion, and at the very latest 2 to 3 months before. That allows enough time for us to get your mortgage in advance, but also means that the mortgage offer won't expire before the property can complete. In terms of the process, what we would say is contact Liquid Expat Mortgages and complete one of our fact find forms. We'll then be able to offer you some individual and specific rates tailored to your situation. From there, once we've helped you decide on the best possible product, we can then apply for your decision in principle or a pre-approval. This takes between 24 to 48 hours. Once we've got this, we'll then start gathering all the documents from you, and the lender will also do a valuation to make sure that the property is a good security for them to lend on. And this typically can take between 4 to 6 weeks, and then we can get your formal mortgage offer issued. So that's the end of the presentation. What we're going to do now is go through a couple of questions that we've been receiving, and then Stuart's going to answer those questions for us. So we've received lots of questions in advance of the webinar that people would like to go through and find out a little bit more information on. The main one we've had repeatedly is, of course, the impact of COVID-19 on the UK mortgage market. So I'm going to hand over to Stuart, who's going to give you a brief overview of the current state of the mortgage market and also perhaps some future impacts of COVID.
Okay, thank you, Rebecca. I think to best answer that question, I think we just need to literally go back to March and explain some of the reactions that the lenders took from what was happening in the general country marketplace. Obviously, back in March, the pandemic started, and the Bank of England made 2 rate cuts in that month, down to, well, it's a historic low in the bank's history of 325 years. They reduced the Bank of England base rate down to 0.1%. So in line with that, the government in the UK almost introduced wartime fiscal measures to prevent a loss of employment, such as the furlough scheme. And in the midst of the pandemic happening in March, probably about 40 to 50% of the lenders we had on panel literally decided to stop taking in any new mortgage applications for 2 or 3 obvious reasons. One is the uncertainty of what was about to unfold. Secondly, the forbearance measures that the UK government had asked the banks to honour with mortgage holders, whereby they could apply for initially a 3-month mortgage holiday period. And from an operational point of view, banks and the lenders were their resources were taken up dealing with existing clients who were looking for forbearance, basically, with their mortgage payments. So lenders sort of decided to stop new applications coming in for those 2 reasons, and thirdly, the fact that valuers, the whole valuation industry, couldn't actually go out and perform physical valuations on properties. So March was a month that ended with 50% of lenders decided not to take any new applications, and then in April of this year, we saw banks and lenders take a more proactive view of how they could actually progress mortgage applications using automated valuation models, whereby they could negate the necessity for a physical valuation to happen. So in April, more and more lenders looked at ways around how they could allow valuations to proceed, whereby they could do their own, what's referred to as a desktop valuation, to be able to issue the formal mortgage offer. And they were quite selective in the type of properties that they would allow these automated valuations to happen on. Towards the end of April, the housing market started looking at ways that they could adapt to this new normal, and virtual viewings of property became something that customers, buyers, started to try and comprehend how they could look at buying properties, whereby they would be able to have a virtual tour of a property. And I think in May, when the signs of a start of unlocking down the economy became more of a reality, we saw more and more lenders that gave us green signals, green lights, that they were going to come back into the marketplace with almost terms and offerings that they were offering before the pandemic was declared in the country. And it's one thing that many participants in the mortgage industry were quite surprised that lenders were very quick to actually come back and start promoting their revised propositions, which weren't too far away from what they were offering before the pandemic was declared. And what's happened through most of this is that the government have been given an unprecedented amount of support to consumers in the country, with the likes of the furlough scheme, but also they reintroduced in March a term called term funding schemes, which ensures that there is liquidity in the banking industry to be able to provide credit. And the term funding schemes were first introduced after the global financial crash, and they reintroduced them in March, along with signs of QE, or quantitative easing. So from a liquidity point of view, there is liquidity for the banks to keep funding new mortgages. And obviously the month of April gave the industry time to get their operations in a position where they could deal with the initial tranche of customers wanting mortgage holidays. And I think as it stands at the moment, 1 in 9 mortgage holders in the UK have actually requested a mortgage holiday. So as it stands on the 26th of May, we've now got 90% of our mortgage panel back on track, receiving new mortgage applications with loan to values not dissimilar to the beginning of March, and mortgage rates not dissimilar to the beginning of March as well. So it's a very encouraging sign how quickly the lenders have come back into the marketplace, willing to take on applications. So with that, in terms of what are our clients likely to expect applying for a mortgage now than what they would have expected at the beginning of March, I don't think there's going to be too much as it's difference on the loan to value that they can apply for. The rates, the rates are not too dissimilar, but I think the big thing that clients are going to have to get used to in these current times is perhaps being asked questions when they're applying for a mortgage that they haven't been used to being asked before or having to think about before. So one of the trends that we're seeing is that lenders are basically asking and assessing applications, and they're asking applicants questions such as, how safe is your job? What sectors are you working in? And they're formulating their own underwriting on certain countries, certain sectors in countries or within an economy, such as the airline industry, the hospitality industry. So clients are going to have to get used to being asked questions that, even from taking a buy-to-let mortgage, that they perhaps haven't been asked to think about before. And lenders are also, they've got a responsibility to obviously lend out money in a responsible manner. And even from a buy-to-let mortgage now, they're starting to ask questions about the underlying tenant of the property. What sectors do they work in? How safe is their job? And with that, lenders are asking how much cash savings as a mortgage borrower got to ride out any periods of the tenant not being able to pay their rent. So I think the rest of the year for new mortgage applications, there'll be some more sensible but questions that perhaps mortgage applicants haven't actually been used to being asked. I don't know if you've got anything to share with Rebecca on any sort of specific applications that you've been working on recently.
I've had, so recently what Stuart said there is very correct. So I've had some additional questions around background savings and assets. Again, just to give lenders more peace of mind that the client is going to be able to maintain those mortgage payments if for any reason their tenants aren't able to. And we've also had lenders who will send out just a very general list of questions they send to everybody. It's certainly not aimed at a particular person or group of people, but just a clarification on the security of their job, the impact of COVID, i.e. are they able to work from home? And I think that the reason that that's so key in the expat space is because the lenders aren't necessarily up to date on what the lockdown situation is in each individual country. Yep. So, for example, here in Hong Kong, we're very able to go back to work where necessary. There are still, of course, social distancing measures in place, but we're further down the line of the COVID journey, for want of a better phrase. Yep. And therefore, the lenders are just double checking that that's going to be, the clients are still able to go to work and those kind of things. So I think those questions are more key because the lenders need to get clarity of what the situation is in each individual country. So I think you're absolutely correct. People just need to get used to maybe answering a couple of questions that they wouldn't have had to previously. Try not to take them personally. That's certainly not the way they're intended by the lenders. Yep. It's to give the lender that peace of mind.
And I think with the additional questions they're asking about the mortgage borrower, for a buy-to-let mortgage application, I think similar questions are going to start being raised about the type of property that they're looking to purchase. or the type of property they're looking to refinance. So I think the day of just putting in a buy-to-let mortgage application and the valuation meeting a certain level of price that someone's buying it for, I think there's going to be more analysis on, is this subject property? What type of tenants is it likely to attract? And with the type of tenants that it's likely to attract in terms of obviously the location in the UK, the location in the town or the village in the UK, the lenders on behalf of the valuers and vice versa, they're going to be asking more questions about the quality of tenant and their ability to keep sustained rental payments going. So in a way, on the one hand, it should encourage or force borrowers to delve a little bit deeper into the property type and the property location where they're looking to buy for investment purposes.
Yeah, absolutely, absolutely.
So as closing thoughts of where we are at the end of May, I think there are some very significant positives about the UK mortgage market. I think the government have done everything in their power to ensure that there aren't any knee-jerk reactions in the economy to put huge pressure on house prices. The furlough scheme and the mortgage payment holidays, they provide some stability through these periods of uncertainty. The liquidity measures that the Bank of England have allowed lenders to adopt, I think it will ensure a supply of new mortgage credit and new mortgage monies. So I don't think there'll be credit crisis like there were 10 plus years ago. I think lenders have been quick to adopt new ways of working and to solve new problems in progressing mortgage applications. And I think where we've got an economy where Bank of England base rate is at an all-time low of 0.1%, we're facing a very different way of growing our way out of the economy shutting down for 2 months than the problems that we faced 10 plus years ago. So I think there are lots of positives from the supply side, from a lending point of view, and from a demand side, with the stability that the government have ensured to do their best to prevent any knee-jerk reactions in the house price economy of the UK. I still think that investors around the world are still looking to take advantage of the FX rates, with the pound being under pressure, and the maturity of the UK housing market. So hopefully that's provided some sort of insight into what's happened in the last 2 or 3 months in the UK mortgage market, and our insights into what we think is going to happen in the next few months. And what we'd like to do towards the beginning of, or the end of Q3 this year, we'd like to run another webinar to give an update on where the mortgage market is at that point in time. So thank you for your time. Thank you, Rebecca.